Hi, everyone. So today we are running the last of the DeFi series, and I'll quickly recap what we did in the earlier webinars because I see some of the new participants who have joined today. So we started our DeFi series with the basics of DeFi, what DeFi is, and how decentralized finance is disrupting the traditional finance industry. And the reasons are very clear, like blockchain and smart contracts, based on which the whole concept of DeFi came in. It is bringing trust and transparency. It is cutting down unnecessary intermediaries, and at the same time, it is much more inclusive. So, like any decentralized platform or decentralized app, anybody with a wallet can join a DeFi app and start transacting. So that is, it creates inclusiveness. And we know that there are still billions of people who are outside the banking system. And then, in the second webinar, we talked about various core components of DeFi, whether it be stablecoins, whether it be decentralized oracles, smart contracts, and various other components. And then, the third and fourth webinar mainly talked about various use cases to give a better understanding or deep dive into the various use cases of DeFi. So in the last episode, we covered about DEX and DeFi lending. I'll quickly recap because if you see the other use cases, they are quite linked to DEX and DeFi lending. So when we say DEX I think is one of the major use case, and that's how the DeFi started, because the concept of DEX started with 0x protocol, almost in 2017. And the idea was that, blockchain being a decentralized technology, still largely all the tokens were being traded on a centralized exchanges. And centralized exchanges have their own set of problems. Yes, they provide a huge benefit because they are user-friendly. It was easy for users to move from Web 2 to Web 3. Using a centralized exchange, they could easily trade tokens the way they have been, transacting shares on a demat account or on a stock market. So, so from a user perspective, it was very easy. It was very user-friendly. It was, you did not have any hassles of managing or keeping a custody of your own tokens. But at the same time, as more and more users are getting comfortable taking custody of their own tokens, managing their private keys, the concept of DEX started becoming more popular. And then, some of the DEXs were launched during COVID. Uniswap and PancakeSwap came in. So Uniswap on Ethereum, and then PancakeSwap was just a copy of Uniswap to start with, built on the Binance ecosystem. And then these two decentralized exchanges, still allow all the crypto to be traded, but in a very decentralized way. And the way these DEXs work are that they have a liquidity pool, and people can provide liquidity providers. If you have idle crypto in your wallet, you can become a liquidity provider because the idle crypto in your wallet is not generating any interest. So there were already a problem how to make money out of crypto that you don't want to sell. You want to keep it for a long term and gain some interest out of it. So there were liquidity providers who provide liquidity to a pool. And then on the other side, using this pool, the sellers and buyers can trade on cryptocurrencies. And whenever they do a trade, they pay a transaction fee, and bulk of the transaction fee goes to the liquidity providers as interest for providing the liquidity. So this is how typically a decentralized exchange works, the majority being Uniswap and PancakeSwap. And then there are hundreds of other DEXs now, some specific to a protocol. And some of the old ones like Uniswap, etc., have become multi-chain in the sense that they have created pools across Ethereum, Polygon, and various other chains like Avalanche, etc. Second topic we covered was DeFi lending. Now, DeFi lending again if you see the startup called Ethlend, they tried to, initially with the concept of Ethlend, the whole idea was to create a lending and borrowing kind of mechanism within blockchain using blockchain technology. But it was very similar to how traditional lending works. So there is a lender. So if you see peer-to-peer lending protocols in the Web2 world, in traditional lending, so there are unorganized lenders on one side and there are borrowers on the other side. Now, borrower place an order that I want to borrow this much money at these kind of terms. And similarly, lender also, offer their terms of lending. And then borrower can pick and choose which lender or there's a matching engine which matches these request and to borrow and the lending terms. And then accordingly, the matching happens. Now, as we have seen in the traditional lending space also, this is highly inefficient because sometimes, the terms are so different that the trade or the transaction does not happen. So that's where, Ethlend evolved into Aave. And during that time, the whole concept of liquidity pool using compound, etc., who gave the concept of pools came in. And then, Ethlend was transformed into a liquidity pool-based lending. And when we talk about liquidity pool-based lending, it becomes very seamless because there's, again, like DEX, there's a liquidity pool. And there are liquidity providers who provide their idle cryptocurrencies to earn interest into the pool. And then borrowers can come in and borrow using that pool. And they pay a certain interest. And whatever the spread is, the spread goes to the lender, as well as a part of it goes to the platform. So that's how our DeFi lending platform works. The major ones being Aave and Compound, and then we have MakerDAO, where you can borrow funds. Yes, DeFi lending itself is now further revamping in the sense that right now, most of the DeFi platforms, if you see Aave, etc., who are the largest platforms, the collateralization is very high. So like in traditional lending, when you borrow something, you provide a collateral. So in the case of DeFi lending also, you need to provide crypto as a collateral. So from a borrower perspective also, let's say you are a borrower and you have got 10 Ether into your wallet. You don't want to sell those Ether. You want to keep them for the long term. But today you require cash. So you can go to Aave, you can put in your 5 Ether, and then against 5 Ether, let's say the collateralization is that you need to have a collateral which is 200%. Then if you provide Ether worth $10,000 to the Aave protocol, you will get 5,000 worth of USDT in return. And you can use those USDT for your immediate need. And then whenever you want to return, you can always return back this 5,000 USDT and get your Ether back. So it's a very simple, but the thing is that the collateralization ratio is comparatively very high. And the reason is very clear because today we have huge volatility. And the reason for volatility is that the market is still smaller as compared to a market like USD. So as the markets are growing for Bitcoin, Ether, and rest of the tokens, the volatility also will come down. And then we'll see these collateralization ratio will come down. And then there are a few other initiatives which are trying to bring this down, or even claiming to have unsecured lending kind of concepts within the DeFi. One such partner we have is Ledger Score, who are building credit score for the DeFi world, like a FICO or experience score in the traditional lending. Again, the idea is that these kind of scores will reduce the need for larger collateral. So the collateralization ratio will further decrease. So this was a recap of DEX and DeFi. Now let's jump on to some other topics. So first one, let's talk about tokenization overall. I think separately seeing, we have seen fungible tokens, non-fungible tokens, and now a new standard has come in, which is called semi-fungible tokens. And then, there are different other kind of tokens like synthetics or derivatives, etc. So there are a variety of tokenized use cases. Now, but the essential part is what exactly is a token and why this is central or a core component of the DeFi space. So token represents something of value. And the best part is that when we talk about token in a blockchain kind of network, so we are talking about token which represents a value, which is a traditional concept. But in addition to that, now any transaction using this token, everything is transparently available. So all the transactions pertaining to a token are written into the blockchain ledger, and anyone and everyone has access to that ledger. So now we have all the transactions open and transparent. Second, these transactions are immutable. So any token transaction which is happening are deterministic, they are final, and they are immutable. So again, you can trust the ledger that, once the transactions have been done, there's no way to change those transactions or edit those transactions or hack those transactions. And then, when token standards came in, so this was like the concept of token, which with Bitcoin itself being a token of the Bitcoin network. But adding smart contracts to it and adding standards to it, now when we say a token standard like ERC20, which is a fungible token standard. So when you use a fungible token standard, you're creating fungible tokens which has got a certain property, but they are interoperable across all the smart contracts within the Ethereum network. Now that itself creates a beauty, because there are 5 different startups creating 5 different ERC20 tokens. Now these tokens can talk to each other. Today we use these standards seamlessly. So if you go to any DEX, you are, let's say, exchanging Ethereum vis-a-vis USDT, which is ERC20 USDT which has been created on Ethereum network. You can easily exchange these 2 tokens. And the reason is because unlike what we see in the forex market, if you talk about 2 different currencies, they have a different supply, different demand, there's a different rate of exchange, etc. In this case, both the tokens can be easily transacted with each other, and all the transactions are going into a common ledger. So you can do the transaction using a common standard because these 2 tokens have a common standard. And second, all the transactions are going into a single ledger. You can see all the transactions pertaining to these 2 tokens, and the balances, etc., automatically matches. So that is what the second piece to tokenization is, the token standards. Similarly, we have non-fungible token standard, which is ERC 721 or 1155. So if you see, tokenization is the central piece, and once you understand tokenization and how smart contract-based tokens, which follow a certain standard, how they are composable, can be used across the ecosystem, that you will be able to understand rest of the pieces, like derivatives or DeFi lending. So it will be very clear how composability of smart contracts plays a huge role in DeFi. And this is one of the major change or disruption as compared to traditional lending, where different products have got different metadata and they are not talking to each other. Whenever a new product, financial product, comes into a traditional world, it is defined in a different way, and it is not exchangeable, or it cannot talk to the other products, right? So that is where DeFi takes a big leap in terms of a technical concept and as far as the impact it has on the business side. So tokenization, of course, it makes it very easy. It increases the liquidity, because once you tokenize an asset can be transacted. So apart from trust and transparency, now, blockchain networks being global in nature, anyone can participate and, buy or sell these tokens. So of course, it increases liquidity because it gets more participation from more users. And since, these token, like fungible tokens, are divisible, of course, you can take fraction of a tokens also. And when we talk about real world asset tokenization in the case of NFTs, there also the concept of fractional NFTs have come in. So you can take a control of just a fraction of an NFT or a tokenized real world asset. So again, it allows retail investors to invest into assets which are very expensive per se. So if there's $1 million property, not everyone would be able to invest or buy $1 million property, but with fractional tokens, you can take a small percentage of that 1 million property. And since there are no intermediaries involved, The settlement is happening almost at the near real time as the transaction happens. So you cut down on a lot of settlement related issues. So to clarify this point further, today when we do banking, we see that, with fintech revolution in last 20 years, we see as a user that, the transactions are happening. I go to the ATM, I, just simply put in my debit card or credit card and I can withdraw cash. And, my balance is reflected within my banking app. But that is what from a user side you are perceiving it. But the actual effect of your transaction, let's say you withdraw 10,000 rupees cash, that transaction, the impact of the settlement of that transaction takes a huge amount of time, because the bank, there's a back-end infrastructure within the bank which handles this transaction settlement. In the case of blockchain, the transaction and the settlement are almost happening at the same time, and that again cuts down on a lot of back-end clerical work that goes into managing the balances, the transactions, the assets within a banking ledger. So as I mentioned, I'll take very simplest examples, but then there are various other kind of token standards now. But the most common ones being ERC20 tokens. Most of the utility tokens that you see in the market today are ERC20 tokens. Your Bitcoin, Ether, Bitcoin, we can keep it separate, but if you see Ether, USDT, etc., all are ERC20. And in fact, some of the new blockchains that you see, they are also following the same standard. So if you go on any EVM compatible new blockchains like Avalanche, they also follow the same standards. The whole concept of providing EVM compatibility, this word, I think, when you come across a new blockchain protocol, you will see this term very commonly used, that this blockchain is completely new, is different from Ethereum, but it is EVM compatible. So EVM stands for Ethereum Virtual Machine. And once you make your blockchain compatible with EVM, then you are compatible with pretty much all the ecosystem components of Ethereum. So you can use the same wallets like MetaMask or MyEther wallet to access your tokens for Avalanche. And at the same time, similarly, you can use these token standards because you have a similar smart contracts. You can port over your Solidity contracts from Ethereum to new blockchain very easily because they all follow the same standards when they provide EVM compatibility. The second is NFTs. NFTs have been a rage in last few years, starting with collectibles. So we have seen collectible marketplaces like OpenSea or Rarible, where a huge amount of non-fungible tokens have been created out of digital art, and now it being extended to music, videos, and various other pieces within the digital assets space. But now NFTs, in 2022, we are talking about, and there are quite a few ventures who have already done this. They are talking about tokenizing real world assets, whether it be carbon credits, whether it be invoices or loyalties, embed that into an NFT, and then, you can trade in that. Bonds, etc. are now being seen in a different scenario using NFTs. So NFTs are extending beyond the collectibles to a whole real world asset space. And that's where I've mentioned tokenized real world assets. So now real world asset tokenization does not mean that they essentially will be NFTs. They can be NFTs, they can be fungible tokens, they can be semi-fungible tokens, depending on what kind of asset we are talking about and how that asset is going to be used. So distinctly, if you see, fungible tokens means tokens that are same to each other. They are identical to each other in the sense that they can be replaced with each other, right? So these are fungible tokens. All our fiat currencies are fungible tokens, right? So a 200 rupee note are easily exchangeable with each other. Unlike that, so you can have n number of tokens having the same property. So you have quantity here in the case of fungible tokens, but the features or the metadata of each token is pretty much the same. In the case of NFTs, vis-a-vis that, there are some unique assets, non-fungible assets that cannot be exchanged with each other. An artwork by Leonardo with vis-a-vis another artwork, cannot be compared or cannot be exchanged with each other. So they are unique assets, unique properties. So it can be creative art or music, or it can be a real estate property. Now, each has got a distinct set of features, and that's why they are non-fungible. And when we tokenize these kind of assets, they are non-fungible tokens. So in fungible tokens, you have quantity. In non-fungible tokens, you have uniqueness of feature. But then there are needs where you require both. So you want to have uniqueness also, but at the same time, you want to have multiple copies of it, right? You want to have quantity also added to it. So there the concept of semi-fungible token comes in, which brings together both the standards together and create a new standard. So top 10 benefits of tokenization, as I mentioned, one, you have globalized access. And just share that there is a globalized access and there is a participation of retail investors due to fractionalization. It increases the liquidity of that asset. Most of the assets today are highly illiquid just because there are not much retail participation into those assets. So once we get retail participation and of course, when you make it global, then, users across geographies can participate in buying and selling those assets. So in effect, it helps in increasing the liquidity of those assets. And as I mentioned, quick settlement, where settlement is happening almost at the same time as the transaction takes place. It's cut down on a lot of data management challenges or asset management challenges. And then, since they are smart contract enabled, you have full transparency on each and every transaction, who has done that, and the clear ownership of each and every asset. So if you talk about NFT assets, if you own an NFT, you are absolute owner of the underlying asset that NFT represents. And one of the challenges that has been talked about blockchain is on scalability and efficiency side, that the number of transactions that can be processed is very low in the case of Bitcoin and Ethereum. But that problem has been solved to a larger extent, and it keeps getting better and better. So in last few years, we have seen the surgence of a lot of layer 2 protocols. So layer 2 protocols solve the scalability challenges of the layer 1 protocols. So if you talk about Ethereum being a layer 1 and Polygon being a layer 2 protocol, so Polygon, helps process transactions on a separate blockchain and then post those transactions on layer 1 Ethereum, thereby, taking a lot of processing out of the layer 1 and bring that to layer 2. And today we have a lot of layer 2 protocols like Polygon. Then we have Optimism, we have Arbitrum, etc., who are taking away a lot of the challenges of scalability on the layer 1 protocols. Apart from that, then, new blockchains are coming in with an entirely different kind of consensus and the way data is being managed. One of the latest example is Shardium, which is bringing sharding-based blockchain. So due to parallel shards being operating, the throughput will be very high. So now today there are quite a few blockchains which are claiming transactions above 5,000 transactions per second to even hundred thousands of transactions per second. So once we start processing transactions in thousands and hundreds of thousands, of course we are talking about the scalability will be pretty much similar to what we see in the Web2 applications. So this was a brief about tokenization. Now, one of the other core component that we briefly touched on the episode 2 was stablecoins. So stablecoins again are very essential for the wider DeFi adoption. And the reason is that, as the utility tokens, most of the network tokens that we have today, and other tokens belonging to DeFi apps, etc., they are largely either governance tokens or utility tokens. But there is a lot of speculative value attached to it. And since the market size is small, the market cap is small, and there's a lot of speculative value, the volatility is very high. But we know that, when we want business transactions to happen, we cannot depend on a highly volatile currency, right? And we have seen this, in the traditional finance also, whenever there's a challenges related to economy of a country, people start moving towards currency which is more stable. So if you see some civil wars happening, etc., people just shed away their local currency and they move on to currency which is more stable, like USD or Euro or INR for that perspective. So the same way, in the blockchain space, there was a need for currencies which are stable in nature. And stable coins are completely stable in nature because they are backed by or they are pegged to US dollars. So one coin, one token is equivalent to $1. So the only now volatility is equivalent to the volatility which is there with US dollar. So stable coins are required for increasing the number of transactions. Let's say you are holding certain tokens for subsequent transactions. You would not like the value of those tokens to change. Similarly, for all business transactions, people paying in crypto to freelancers or for any other business transaction, for services, for products, etc. All those transactions are being done using stable coins because, again, you do not want the value to change. So stable coins are crypto which are typically backed by or pegged to US dollar, or it may be any other fiat currency. Largely, most of the stable coins today are pegged to US dollars. And stable coins have become huge now. If you see some of the major ones like USDT Tether or USDC, which is backed by Coinbase and Circle, they have become large in terms of market cap. If you go to CoinGecko and see the list of cryptocurrencies by market cap, which is the default presentation on CoinGecko, you will see that USDT Tether is among the top 10. So this clearly shows that why stable coins are so valuable, why their market cap and overall transaction volume is so huge, because people use them for doing all kind of business transactions. So in terms of stable coins, there are quite a few, almost 5-6 type of stable coins. I'll touch upon just 3 which are the most common. So the most popular type of stable coin is fiat backed. Very easy to understand. It's a centralized kind of concept. You take an example of Tether or USDC, USD coin. So concept is very simple. There's a trust account in which, let's say, you put in $100, a proper fiat cash, and vis-a-vis that you can mint 100 new tokens. And similarly, if you add more funds into the bank account, similarly you can mint more tokens which represent that cash in the bank. So it's an asset-backed cryptocurrency which is backed by or pegged to $1. So the only thing that needs to be taken care of is that the underlying asset is secured, so that it's not that you have got $1 million in account and 1 million tokens have been minted, but then later on that 1 million underlying cash is not secure. So that is definitely an important piece, and that is one of the major disadvantage also of fiat-backed cryptocurrency is that, or fiat-backed stablecoin is that there needs to be a continuous audit so that you can be sure that the underlying cash has not been moved or has been reduced or been spent. And otherwise, if you see, that's why USDC is growing up rapidly, because USDC has been promoted by Coinbase, which is a listed company in US, and Circle, which again is a very large payment startup based out of US. So USDC is picked up. So here it's a matter of trust on the organization which is launching the stable coin. But otherwise, they are very easy to understand, very simple concept, and straightforward. The peg as well as the collateral is US dollar itself. So it's very easy. So most of the most popular stable coins today are fiat-backed stable coins. Binance also launched BUSD, which is running on the Binance network and now going beyond Binance network. So BUSD is also one of the largest set of stable coins which are fiat-backed. The second very popular is crypto collateralized. If you take an example of DAI by MakerDAO, so it's crypto collateralized in the sense that you know, you can put in a crypto like Ether and you can mint DAI. And DAI is always again pegged to $1. The value of one DAI would be equal to $1. And here you are providing crypto collateralization, and rest of the logic, the way I explained on DeFi lending. So it's pretty much the same, that you put a collateral, you mint DAI, which are like USDT, or in this case DAI, and you can use that DAI for any purpose. And then once you return the DAI back, you can get your collateral back. And if the value of the collateral goes below a certain value, then a liquidation may happen. So either you need to, as a user, is responsible for managing the total collateral in the system so that the liquidation does not happen. So crypto collateralized DAI is also again one of the top organization, one of the by market cap, and it's very commonly used. The third one is algorithmic, which was pretty much unknown till 1 year back. But now everyone knows about algorithmic stablecoins, especially after the debacle that happened with Terra. So algorithmic stablecoin, the concept was that create a stablecoin which is governed by an algorithm, and there is no collateral per se. And what we mean by algorithm is that, you know, the price of any asset is based on the demand and supply, right? So if, let's say, demand goes up for any asset, any token in the market, the value of that token will go up, the value of that asset will go high. So just imagine there's a huge demand for gold suddenly come in, and the gold is limited in nature. So of course the price of gold will go up. Similarly, if there's an increased supply and less demand, the reverse will happen. The price of the asset will go down. So an algorithm basically manages the supply and demand to ensure that the value of each token is pegged to $1. So just imagine a Terra which has got a price of $1, and suddenly the demand of Terra goes up. So the price of Terra will go above one. You know, it may become $1.05, $1.06. Then in that case, what will happen is more Terra tokens will be minted and moved into circulation to meet that demand, and the value will again drop to $1. And if reverse happens, let's say the supply is more, demand is less, then the value of one algorithmic stablecoin may go to 94 cents, 97, 98 cents, less than $1. So in that case, the algorithm will move the tokens out of circulation. And as the tokens are moved out of circulation, the supply will go down and the price will again stabilize at $1. So that's how algorithmic stablecoins are working. Unfortunately, Terra had an incident where through an orchestrated attack, this demand supply equation was disrupted, and it lost its peg. And you know, once you lose a peg again and again, then there's a loss of trust. And once a loss of trust happens, even the largest of financial institution of the world cannot manage that. End of the day, all the financial institutions are running based on trust. So these are the three types of stable coins. Most commonly, we have been using fiat-based. Algorithmic HUSD, recently Huobi USD, and there are quite a few other algorithmic stable coins. So algorithmic stable coins are getting evolved as financial products. When they come in, sometimes they may have some kind of weaknesses that may be exploited. But over a period of time, we get to see that yes, improvement happens. Before I jump on to next topic, I think I'll take some of the quick questions. One question from Vishal is, what is utility token? So the concept of utility token is a token that has a utility within a system. So I'll answer this, vis-a-vis, take an example of a utility and a security token. So Ethereum in an Ethereum network. So if you see Ethereum blockchain and there's a native token, which is Ethereum. Now, why Ethereum is a utility token? Because when you use any smart contracts or when you do any transactions on Ethereum network, you pay a gas fee. The gas fee is paid in the form of Ether. So you're utilizing that token to transact within the blockchain. If you just remove Ether out of Ethereum blockchain, the blockchain itself cannot operate because no one would be able to pay the gas fee. right? So native token is providing a utility within the network, and that's how the network is operating. So these are called utility tokens. Most of the tokens that you see in the market are utility tokens. Some of the tokens are claimed to be utility, but they are not, because their token economics has not been well defined in the system. Otherwise, a utility token means that it has got a sound utility. It captures the value of the network. So like when we see traditional organizations also, in the case of network, the value is number of transactions, number of users, and whatever fees accruing. That is all captured in the form of token. So these are called utility tokens. Vis-a-vis that, if you see a security token, so let's say you have an organization and it has got shares, and you just convert those shares into a token. So let's say your company has got 100,000 shares, and you convert 100,000 shares into 100,000 tokens, and you say that, okay, I want to raise funds, and anybody can take these tokens. I want to raise funds against 30% of my tokens. So 30,000 tokens I'm putting away. So anybody can buy those tokens, and then they become shareholder within your organization, right? They own a certain portion of your organization. These are called security tokens. So that's what a different is. So Ethereum per se is a network. Cryptocurrency was the common term when Bitcoin came in. Token word came in because not every cryptocurrency that was created later was actually a currency. So in the case of Bitcoin, the word cryptocurrency was used because the major use case of Bitcoin was to make payments, right? So whenever a crypto token is largely being used as a payment token, then we call it a cryptocurrency. But otherwise, we call them crypto tokens, because there are quite a few tokens where the purpose is not of payments, but purpose is used for something else. Like if you go to Uniswap has got a token which is a governance token. Now the token is being used for governance. So I would not call it a currency, because the purpose is different. The utility is different. So utility can be beyond payments, and that's why they are called such. Now, interesting question by Shivam. Is it possible that whichever crypto we buy in Binance goes to a pool without knowing us that they are getting interest on it? Yes, of course. That is how centralized exchanges, because of course they are holding on so many tokens, like the way bank does. You make a deposit to a bank is holding huge amount of funds. They use these funds to lend to the market, right? So similar thing definitely happens, but nobody knows the inside working, how those funds which are there with centralized exchanges, how they are being utilized. But yes, potentially they will do, because they are providing you services on the front end. But now, Binance has gone one step further. They have created their own staking pools. They have created, n number of products within the Binance ecosystem. So you can, whatever tokens are there, you can actually put those tokens and you can earn interest on that. So now this thing may not be possible, because users themselves would, put those tokens into one of the staking pools or saving pools and start earning interest on that. But of course, what Binance is doing with that funds, when they are paying you 4% on something, then they must be making more than 4%. That's why they are able to pay you 4%, right? That's how the banking system works, or that's how any financial system works. Okay, so we'll take rest of the questions later. So as I mentioned, users of stablecoins, they are being used as a medium of exchange. That's a major use case. And also for, store of value in the short term. Because if I'm, let's say, storing, let's say, taking a simple example, let's say you raise funds for your venture using crypto, and you've raised funds in Ether or Bitcoin, right? So you had a target of raising $500,000 or $1 million, and you raised in Bitcoin. And just imagine that, you have kept that funds in the form of Bitcoin itself. Now there are both the options, if the value of Bitcoin goes down, your total raised amount goes down, which was supposed to be used for your business purposes, right? So there's a risk involved. So you would not, so there are certain kind of funds that you don't want to risk. That's where stablecoin comes in. So you will quickly convert those Bitcoin or Ether into USDT and keep it as a USDT. So, and then, various other features like within the DeFi ecosystem, dApp transactions, etc. Stable coins are being used. I'll skip this. Derivatives, I think, is a very complex topic. So I'll just give a brief introduction of what derivatives are. So derivatives are contracts with values which are derived from the underlying assets. And if you have been into a traditional stock market, you must have heard of the words like FNO, futures and options, or perpetual future contracts and perpetual contracts. So these are derivatives. So derivatives allow you to trade into an asset without owning the asset. So typically what happens in a spot exchange, if you're, let's say, stock market, you have got 100 shares of TCS and you want to sell them and convert them into rupees, and using those rupees, you want to buy something else. So there you are taking delivery of those assets, right? So you need to have the asset before you can sell it. Same goes for centralized exchanges. You have Bitcoin, Ether into your Binance account. You need to have tokens to do a buy and sell transaction. Derivatives are contracts, or derivatives are the way where you can trade into a asset without owning the asset. So let's say in your account, you do not have any Bitcoin, right? Or you have a Bitcoin, which is just worth $100 in value. But you see a big opportunity that, okay, I know how the Bitcoin is going to move in future, and I want to make some money out of it. Derivatives allow you to do that. So you do not need to own Bitcoin to even operate in derivatives related to Bitcoin. So taking an example of future contract, what a future contract is. So let's say there are two users, A and B, and today the value of Ether is $1,600. Now A believes that the value of Ether will go up. It may go up to 1,800 or 2,000 after a month. And there's a user B which believes that, no, I'm bearish. The value of Ether will go down to 1,100 or 1,200 after a month. So they can get into a future contract where they say that, okay, A is going to buy Ether after 1 month at the value of current value, which is 1,600. And B says that I'm willing to sell this future contract at 1,600. So A is buying the contract, B is selling the contract. Now they get into a future contract. Now after 1 month, 3 situations can happen. One situation is that Ethereum goes up to 1,800. The second is Ethereum can go down to 1,200. And the third is Ethereum stays at 1,600, right? Now, what will happen if Ethereum goes up to 1,800? Now, A has signed a future contract to buy Ethereum at 1,600. So A has made a profit of $200. Similarly, B has made a loss of $200 in that scenario. If the Ethereum value goes down to 1,200, then A is going to buy after 1 month, is going to buy the Ethereum at 1,600. So of course, making a loss of 400. And B will make a profit of 400. And if the value remains same, then of course, they both are happy. They are not very happy, but satisfied that the value remains same. So this is what a future contract is. And in traditional market, derivatives are the largest category in which transaction takes place, whether it be FNO or perpetual contracts. Similarly, in the case of DeFi world, there are players like Yield Protocol or DYDX who are providing you margin trading and derivatives. So you can, and now coming back to the statement which I made that you can actually transact in derivatives without owning the asset, what exactly it means. So essentially in the example which I gave of A and B, essentially what is happening, after 1 month, nobody is going to buy 1 Ether and do a transaction. No, it's simply, I will, transact in the difference. So if let's say the value of Ether goes up to 1,800, it's not that, B is going to go to the exchange, buy 1 Ether in 1,800, and then give it to A at 1,600 value. It's not going to that. What B is going to do, B is just going to give $200 to A. Our contract is closed. I made a loss of 200. You made a profit of 200. This is your $200. So effectively, if you see, A and B have placed a bet on Ethereum without anyone owning the Ethereum. So that is how derivatives work. So derivative market is increasing because margin trading is, there are quite a few traders who bet on the future prices of assets. So there are BTC futures, there are Ethereum futures, there are futures of various other tokens, and DYDX and yield protocol, etc. have become quite huge. So that is what derivatives are. Very interesting topic, not just as a trader, but because they have very complex smart contracts. The way they work is, it's very amazing. Like sometimes what happens is that, like if you see DYDX, they make a combination of off-chain and on-chain. So the contracts, because right now A and B getting into a contract is just, they have placed their bets to buy a contract and sell a contract, and the contract has got some, but there's no exchange of actual crypto happening at that point of time. So this transaction is signed on the smart contract, but remains off-chain. It is not posted onto Ethereum blockchain. And once the contract expires after 1 month, at that point of time, actual transactions happen on-chain. So there's a combination of off-chain and on-chain that they work. It's a very interesting thing to dig deeper into it. And if there would be a lot of demand from participants, I'll probably conduct a separate webinar on derivatives. Coming to prediction markets, I think very easy to understand, one of the very solid use case within the DeFi, and all prediction related use cases are very strongly popular in blockchain world, because these kind of markets are there in Web2 space also, but the problem is we can't trust the platform who is running these markets. In the case of blockchain, since there's a transparency, there are decentralized oracles through which the actual outcome can be gauged. So prediction markets are becoming very, very popular in blockchain piece. Now, what prediction markets are? So prediction market is nothing but, you are predicting on an outcome. So let's say the question is, will there be a rain in Delhi today? Now, this is a question. Now, everybody can, predict that yes or no. Typically, the answers are binary. And now, when we say that, okay, I'm sure that it will going to rain today, and you are sure that it's not going to rain today. There are no clouds even in the sky. So we can bet on it. I say that, okay, I'm willing to put in X amount of money that it will rain. And you can put in that, okay, I bet against this, putting X amount of money. And whatever outcome happens, accordingly, one wins and one loses, right? And how much you bet on it, that depends on the kind of prediction or the probability of it, right? If it's something very significant, then the bets may be even higher. And second, it may depend on probability. So let's say if typically what happens is, let's say I roll a dice, and the probability of having 1, 2, and 3. So that's typically 50%, right? So we may together bet for and against at 50 cents each. But let's say you come to know that the dice is only a 4-sided die. Then it will have just 1, 2, 3, and 4. So chances of having 1, 2, 3 are 75% now. So then if I'm betting for 1, 2, and 3, then I would be putting in 75 cents. And you are betting against this, you will be putting only 25 cents, right? So this is how typically predictions happen. Now, bringing these prediction markets onto smart contracts means that, there's a pool of funds, everyone is putting their bets, and then as the outcome happens, the funds are automatically distributed to all the participants, depending on what whether they have won or not, and how much they have won. So smart contracts, remove those kind of risks which are there when a central party is running these prediction markets. And second is, why prediction markets in place? It's not just it's not a lottery. So prediction markets are very important because they make predictions about political outcomes, social outcomes, and the best part is these prediction markets are much better than your surveys or your interview-based results that come in. So we have seen that whenever elections happen, different news agencies, they run surveys, they do pre-result polls, and they come up with results. And we have seen that those results are very off. because they are centralized parties and they have limited set of people. And through surveys, you are able to interview 500 people, 1,000 people. But in the case of an online prediction market with a proper trust and transparency in blockchain, you can actually have millions of people who are voting for a certain outcome. So we say that there's a wisdom of crowd, and it has been seen that prediction markets are much, much more accurate as compared to surveys which are done on a smaller sample size or a smaller size of people. So advantages, as I mentioned, with DeFi-based prediction market, there's a lack of central overseer. There is no centralized person who is running the platform. So, and anybody can participate. So now, this wisdom of crowd has extended beyond geographies. Now a global market is there who can, put a prediction. And there are various ways of gauging the outcome. So now we have decentralized oracles like Chainlink, where you can actually see once the outcome happens to bring in that outcome within the platform. It may be a simple price prediction, whether the price of Bitcoin will go up or down today. Or it can be political, like who is going to win the elections. So all kind of predictions are done. Some of the major players are Augur, Gnosis, they are on Ethereum, and then Hivemind, which is on Bitcoin. And then, there are a few other prediction markets coming in, which are specific to a protocol. So different protocols are having different kind of prediction markets. I'll quickly cover on the last topic of the day, DAOs. I had given some details about DAOs in the episode 2 also. So DAOs is a very interesting concept. It's like, a decentralized autonomous organization means, again, an organization which is driven by smart contracts. The rules of the organization, what the organization will do, how it will do a certain function is determined by smart contract based voting mechanism. Just imagine a group of people are coming together and they form an organization, and there are certain rules as to who has what kind of power. If all this can be translated into a contract, embedded into blockchain as a set of rules, then we know that, the chances of disputes, etc., will be much less. And the organization will run very smoothly, seamlessly, and according to the rules that have been decided. So there would be less disputes, less, litigations, etc., while running the organization. So DAOs are supposed to be the organizations of future. As DAOs are becoming more and more complex. But I'll take some of the simpler DAOs that are very easy to understand, and that's how the DAOs started. So one of the use cases is funding, where DAOs are being used, right? Or investments. So I'll take an investment DAO, which was in fact the first DAO. So let's say there are a group of investors who come together and they create a pool. And then, there is a investment philosophy that, okay, we'll invest into blockchain startups only, right? And then, there may be some other conditions, what kind of blockchain startups, etc. So using a smart contract, there's a smart contract based pool. And let's say there are 10 investors who come together, each one put 100,000 each, right? So there is a pool of 1 million USDT. And now since each, and when they contribute USDT, the investment DAO will give a DAO token back to them. So just imagine that one DAO token is for 1 USDT that they invest. So each of the investors will get 100,000 DAO tokens. Now, since each owns 100,000, that means they have 10% ownership into the DAO. And when a proposal for investing in a blockchain startup comes in, there would be a voting mechanism. That proposal will be open to all the 10 investors. They will, based on their DAO tokens or percentage of that, they are going to vote on that proposal. And based on a majority that again is written in the DAO contract, that what kind of majority would be required, whether it be 51% or 70% or 90% before investment can happen. So let's say a DAO contract says that it should be 70%. So as 70% votes come in the favor of a proposal, the funding will happen. Else it will not happen. So this is how you're making the traditional process into a very smart contract driven, rule driven process. And smart contract will ensure that these rules are being followed and there is no way you can change them. And just making it more complex, just imagine there are hundreds of thousands of investors Some have put in, some has got 1% DAO token, some 5% DAO token, some 30% DAO token. So according to what they own, they can make, and then I'm talking about simple investment DAOs where your voting powers are proportional to the number of DAO tokens you hold. But then you can also have a scenario where you can have your voting into two different types. One set of decisions will be proportional to the tokens that you hold, but some decisions is not proportional to the number of tokens you hold. It's proportional to the number of token holders. Even if you hold 100 or if I hold 1, we both have got the same voting right. So depending on the use cases, these contracts are becoming more complex. But the central idea is that now all the decision making which happens in an organization to run the organization, you can encode those as a set of rules within the smart contract as part of DAO, and then govern that. A lot of funding, whether it be related to Ukraine-Russian war or there's an investment DAO which is pitched on a football club. So I've not seen it, but I think it may happen. Let's say a new IPL team comes in, so you may see actually a DAO coming in and where multiple investors pool in the funds into a DAO, and DAO pitching for a new IPL team, right? So investment and funding are some of the most common DAOs today. And then there are collector DAOs like Flamingo, where they are collecting investments and then and buying NFTs out of that. So it may be that again it's a bifurcation of an investment DAO only, where you are collecting funds for a specific purpose. And then in DeFi and exchanges, we are seeing that these DAOs are being used as a governance. So let's say there's a platform like Aave or Uniswap, a DEX or a lending protocol. So based on, and they want to leave some decisions to the community. So they want that, okay, if you want to increase the platform fee or interest rate on a specific pair. So in those kind of scenarios, you say that, okay, we want the community to vote on this. Like for example, I'll take a very simple example. So Uniswap came up with a Uniswap version 2, V2. And in V2, they made some excellent changes to how the price curve works in DEX. And the idea was how to make it easy for liquidity providers to bet on a certain curve, the pricing curve. And so before that, whatever Uniswap did, all the code was open source. And anyone can copy Uniswap and create their own. Like Pancake is a copy of Uniswap, right? But then their community decided through a DAO-based voting mechanism that for 1 year, this code will not be open, V2, because this is something innovative code that we have written and come up with an innovative concept of managing the pricing curve. So it will not be open. And it will open only after 1 year. After 1 year, it will become open source code. So depending on what kind of decision making or kind of governance decisions, people are using DAO again. Aave, Uniswap, quite a few DeFi apps today are using DAO to make decisions about the platform. So I'll skip on the insurance. I think we are running out of time. I'll prefer to take a few questions. So interesting question about CBDC related to crypto coins. No, so CBDC is not related to crypto coins per se. So CBDC is where government is creating a digital fiat, or you can say, take an example of India. So if government is creating a digital rupee, which is powered by blockchain, when we say powered by blockchain, it means it will follow a certain token standard. And at the same time, it will be transacted on blockchain so that we talked about all the benefits of managing an asset like settlement and having all the transactions. You do not require heavy clerical back-end work to manage it. So that is what, and of course, since you have them on blockchain and use a smart contract-based token standard, then you may have composability also into it. And so that is what CBDC. So CBDC is initiative by different governments to create centrally banked issued digital currency. So they are digital currency in terms of technically they are similar to crypto coins, but otherwise they are not related per se, because they are always issued by a central bank like RBI in India. And so they will control the demand and supply, unlike what we see in Bitcoin, Ether, where the demand and supply, etc., has also been encoded into the network itself. So there's a definite supply, and how the new tokens are going to be minted, how many are going to be minted. Everything is defined within the network itself. In this case, central bank, again, like, they control the flow of money within the market. Similarly, they will control the flow of CBDC into the market. So right now, CBDC is pretty much like, using the blockchain technology, some of the core benefits of blockchain to manage the digital currency. So every country is coming out with their own CBDC, with their own purpose. So there are quite a few points in favor and against CBDCs, and it depends on what philosophy they comes in with, and if, let's say, CBDCs are going to be used to invade the privacy of citizens, where they can see what kind of transactions you are doing, what you are spending, where you are spending, etc., then I think it will be a challenge. But if CBDC is being used to bring in efficiency into the currency transactions within a country, of course, it will be a major benefit to the economy. See, fiat-backed stablecoins, yes, they will be at a risk, but only depending on, as I mentioned, the philosophy behind the CBDCs. Because if CBDCs becomes another tool by a government to control citizens, then it will not impact the fiat-backed stablecoins, which are outside the domain of governments, run by private organizations, or like in the case of algorithmic stablecoins, it may be run by a DAO. But yes, if CBDCs are properly implemented with the purpose of using blockchain and taking the benefit of the tech without impacting the rights of the citizens, then I think, yes, CBDC will take a role where stable coins can be replaced, or some chunk of that market can be replaced by CBDCs. So one has asked, any good resources to learn about derivatives and their math and also integration? I think best way to understand the math and how they work, especially in smart contracts. If you want to read about derivatives, I think traditional Investopedia, etc., is a very good resource. So first, you will be able to understand what derivatives are in traditional finance perspective. And then the idea is how that has been taken and put into the smart contracts and how they are happening in DeFi. So there you can actually go through the documentation of DYDX or yield protocol, because these protocols, when they provide documentation, they provide, a complete detail, because these are open source contracts. So they provide the detailing also how it works. So you'll get to know the maths also. And so right now, DYDX supports future contracts and margin trading and perpetual contracts. So you will be able to understand. I've not seen options anywhere right now, but future contracts you will easily find. Ramesh has asked question, what would be the underlying blockchain? I'm not clear as to question pertains to what. Sumit has asked about what went wrong with Terra Luna. So see, as I explained in our algorithmic, I see nobody knows what exactly who made it happen. But what happened was, I can tell you that, as I mentioned, what happens is, let's say there's a ABC bank, right? A popular bank in India. And suddenly you come to know that, there's a rumor in the market that the bank is going down. What will happen? Every depositor in that bank will start flocking to ATMs or bank branches to withdraw their funds, right? So even if there is nothing wrong with the bank, or if the wrong is very small, something that can be rectified easily, such a large withdrawal will push the ABC bank into bankruptcy. Because what happens is, bank has taken certain funds. They have a certain liquidity reserves, let's say 5% of funds. So they have raised 100 rupee from the market. They are putting in 5 or 10 as a liquidity reserve, but rest 90 they have used for lending in the market. So at any point of time, your deposits that you have done, bank is not holding that as a cash with them. So when let's say 60 people start to come in and come to withdraw 60 rupees out of that 100, bank will not have 60 rupees to give away. And since bank will not be able to give away that 60, this will further confirm the rumor that yes, something is wrong with the bank, which is not true, but it will, this is how it will be, perception will be in the market. And eventually you will see the bank may actually go bankrupt until unless there's a major intervention happening from the central bank or some other bank, right? So same thing happened in the case of algorithmic stablecoin. As I mentioned, due to demand and supply, the algorithm ensures that the value is pegged to $1. Now, let's say, just imagine the peg goes down to 96 cents or 97 cents. So what Terra did when the peg went down to 97 cents, what they did, because the price will go down when supply is more. So they bought tokens out of the circulation, investing funds into it, right? Using BTC, they had a reserve of BTC, so they used that to suck in funds or suck in tokens from the circulation. So peg was restored to 1. And then, again, it lost this because somebody was putting in more tokens in the market. Somebody was increasing supply. And then they pulled out more tokens. Then the peg, lost third time again to 94 cents. So this happened 3-4 times. And then suddenly, normal retail investors, they got panicked. After that, they started selling. Now, once they started selling, then just imagine the supply became so huge that Terra also had a limited amount of funds to buy those tokens and bring them out of circulation. Everybody has, even if you put in, they had almost a $1.5 billion reserves, including the loans that they took to keep on buying tokens out of circulation. But, since panic got in, it added to the initial injury. And then, suddenly it became a situation that everyone was selling and Terra, did not have any further money to buy tokens out of circulation. And then, eventually it lost its peg and it kept on. It's the spiral effect that happens. I hope you got some understanding for this. Thank you. Yeah, Sumit, so you can put in your email ID and Paras will share the PPT. In any case, we are going to put the whole presentation on the website. So you can check our Zeev website where we put in the details, including the recording. Thank you, everyone. One question Vignesh has asked is why Binance or other exchanges charge more transaction fee. I think Binance typically charge very low fee. So it's again a volume game. Binance is today is largest exchange by volume of transactions. If you see Coinbase or so these are some of the largest exchanges. So as they become large, it becomes a volume game. So they can afford to charge less transaction fee in terms of percentage. So typically Binance charges less. Other exchanges charges more. Yes, it may be possible you may have come across a larger transaction fee when you are dealing with tokens which are not very liquid. So if you buy something, Ether USDT or some common, where top 50 tokens, where there's a high liquidity, then you will always find the transactions fee are very, very low. Yes, if you're dealing in some tokens, which, and especially in smaller exchanges, like, you will find a lot of new listing that happens. New venture comes in, they list their tokens, they list on a very small exchange. Now, small exchange has got less number of users, less number of transactions, and there's not much liquidity there. So there, the exchange is at risk. And that's why exchange, to cover that risk, they charge a higher transaction fee. Okay, so this was the last answer. If you still have any further questions, you can always connect me with the LinkedIn. You can connect our Telegram or Twitter channels, and we can definitely open up the conversation. Yeah, Vignesh, so I need to push. I have another meeting at 12:30. But yes, you can always connect me with LinkedIn and or Twitter, and you can post your questions. I'll be happy to have a discussion with you. And we'll continue our DeFi series again. We'll repeat the DeFi series from next month so that, more users. And if you want to, let's say if you have attended just 1 or 2 of it, you can always come back and start attending. So we'll ensure that we'll communicate the next schedule, or do follow our website and LinkedIn to get details about the upcoming webinars. But I'll be heavily talking about NFTs and DeFi, and more webinars you'll see. Thank you.